We're back with Ryan Lewenza. He's at Turner Investments Raymond James for a closer look at balancing and diversifying your portfolios. So we often talk about diversified portfolios. It's an axiom of good investing. What exactly does it mean, and what should it look like in this environment?
Yeah, it's a bit cliche. We always talk about diversification, but I think now reinforces this point more than ever. So what do I mean by this? Well, let's look at the declines in the global markets. The S&P, as of yesterday, was down about 15-16% year to date. Toronto Stock Exchange is about 8-9, and EFI up until today was down about 3-4%. So by not having all your money in the S&P or TSX, by spreading it around, you're getting the diversification. You're getting some markets that are holding up better than the other. So that's one way, by spreading it out geographically. We own REITs and dividend stocks. Those are not down nearly as much. Now on the balance side, so we believe in a 60-40 balance side, so 40% fixed income when you look at bonds. Bonds right now, if you look at the 4 bond ETFs we have, when you include the interest payments they've received so far year to date, they're basically flat. Our bonds, up until a couple of days ago, were actually positive. So you've got bonds that are basically flat, up a little bit, down a little bit. You've got stocks that are down anywhere from 3 to 10, 15%. And by overall having this balanced and diversified portfolio, we're down far less. So what does that mean? A balanced portfolio right now, depending on who's managing it and how they've structured it, is down about 5. Our clients, look, we're down. We're down about 4 to 5%. But we're not down 9. We're not down 15 like the S&P.
Right.
And so this just really enforces the balanced approach, essentially the negative correlation that exists between bonds and stock prices. And over the long haul, there is a negative correlation so that when stocks go down, bonds go up. Now, the big scary part right now is this stagflation everyone's talking about.
Yeah.
That's the scary part. Because stagflation is when you get lower economic growth, but then you get the rising inflation from the tariffs, because then the Fed is in a bit of a pickle. But keep it simple. A balanced portfolio is down 4 to 5% versus equity portfolios that are down 10, 15, 20.
What about balance within the equity portion?
Well, then, so on the equity portion, you do this a couple of different ways. Number one is you spread it geographically. So of our 60%, roughly 20 Canada, 20 international, 20 US. So we're getting the diversification. And then second, we're big proponents of ETFs. We're not picking 8 stocks. We own the S&P, we're owning EFI. We own literally thousands of stocks. And there's where you get that broader diversification. The key point here I go back to, listen, a balanced portfolio is still going to be down. You own 60% of stocks. We're down 4 or 5. I bet you many clients are down 10, 15, 20, depending on how risky their portfolios are.
What about geographic diversification within the equity portion as well? As I noted earlier, European stocks until recently were doing very well, and they're still outperforming the U.S. markets.
Cool, that's exactly right. And so you never know for certain. My job, one of my jobs, is to try to figure out what geographies and sectors and areas have the greatest upside. And then I try and tilt that 60% into those a little bit more. So maybe I have 24% in international, a little bit less in the S&P. That's my job. And sometimes I'm going to get those calls right and sometimes I'm not. But we balance that. We protect ourselves by roughly keeping that a third, a third, a third. You never know for certain which one is going to outperform and underperform. But EFI's down 4 or 5. It's not down 20 like the NASDAQ.
Are you making moves in this market?
So I would say 2 points there. We actually raised some cash yesterday, first thing in the morning. So when those futures were up and the markets were up 3-4%, we got a bounce. And I actually thought this might be a little bit of a dead cat bounce. So we raised a little bit in the Toronto Stock Exchange. We now have an overweight position in our cash. Made one move just to have some dry powder. But we are not making any major moves. Now is not the time to sell. We're already down 20%. And if I can really hit home, a key point is control your emotions right now. Now is not the time to be emotional, overreact. So we are staying steady. We're going to get through this period, but we will look for some little opportunities, either A, to raise some cash if you get a rally, or B, turn around and start putting that cash to work. We're not there yet. So right now, don't make any big moves.
That's Ryan Lewenza on a diversified